So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance. The U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
We're entering a financial revolution, not one driven by central banks or Wall Street, but by open networks and unstoppable code. The next decade won't just revolve around Bitcoin's price. It will be about Bitcoin's real-world utility and how it quietly becomes the backbone of a new global financial system. According to Fundstrat's Tom Lee, we're on the edge of exponential growth, not only in market cap, but in the practical integration of Bitcoin and stablecoins into the core of global commerce. Stablecoins, once seen as secondary to Bitcoin, are now emerging as Web3's killer app. These dollar-backed digital assets move billions daily without middlemen, offer profit margins rivaling major banks, and operate with blockchain transparency, not corporate secrecy. Tether alone is reportedly more profitable than nearly every U.S. financial institution. And this system works because Bitcoin secures it from the ground up. Governments are taking note, not to shut it down, but to leverage it. Stablecoins now hold more U.S. treasuries than countries like Germany, turning the U.S. dollar into the default currency of the crypto world. Though the dollar makes up just 27% of global GDP, it powers nearly 100% of crypto trading, and 60% of stablecoin activity now happens in Asia. Tom Lee sees this not just as a bullish signal, but a historic shift. Giants like Amazon and Walmart are exploring stablecoins, and banks are beginning to understand blockchain's unmatched profitability. Bitcoin isn't just a speculative asset anymore, it's becoming the anchor of a new monetary regime. The institutions aren't coming to fight crypto, they're coming to build on top of it. And those who grasp what's unfolding today aren't just early, they're ahead of a transformation that will redefine the very concept of money. This is how you buy and sell crypto the easy way, using eToro, one of the world's leading trading platforms. If you're new to crypto, eToro makes it super simple. Let me show you how I bought Solana in just a few taps. First, head to the search bar and type in Solana. Tap on it, then hit trade. I'm going to invest $10, that's the minimum. Now just hit buy and done. I now own Solana. Selling is just as easy. Go to Portfolio, tap your Solana asset, then click Close and confirm your sale. Super simple. That's how quick and beginner-friendly eToro is. But here's why I use eToro. Earn up to 4.3% interest on non-invested funds, 0% commission on stocks, and you can set up an account in just minutes if you want to start your crypto journey. Use my link in the description to sign up to eToro today and start trading.
I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. When we first wrote about Bitcoin in 2017, and Bitcoin was under 1,000, we had said it could get to 25,000 by 2022 because it's a network value asset. So we just said if you model number of wallets and activity per wallet, which explained 90% of the move of Bitcoin from 2009 to 2017, you would get to 25,000 2022, and you can get to the six figures later. And that's true. It's still like 87% explained by those two variables. But Bitcoin is now about to become a lot more useful for two reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset. And companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail. Like that wasn't a thing, but then people realized it was valuable to own the real estate. Like some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. But banks are also quite interested in Bitcoin because of stablecoins. So stablecoins might be the Web3 app that's really recreating financial services because one, a stable coin works better than a regular dollar.
You don't have to send it through middlemen to transfer
Yeah,
it.
that's right. Now, if you want to move billions and trillions, you just use the stablecoin market. And it's proving to be more profitable for a bank. Circle, like I won't comment its valuation, but as a net income, or Tether is a better example because it's
But
not
how do you
public.
trust those Tether people? Like, you don't really know what's going on.
Well, that's
behind the
where,
scenes.
see, this is where blockchain comes in. Blockchain has proven you don't need to know the counterparty. You just have to trust the code. And so Tether, from a net income basis, makes more money than most financial institutions. I think would be the third most profitable financial institution in the world. So what's a better bank, right? What's a better financial services model is building it on the blockchain. So I think stablecoins is the killer app that's proving, because Bitcoin anchors everything. Because you don't need a stablecoin unless you had Bitcoin. So Bitcoin and building financial services on top of stablecoins, and financial services companies are getting it now. Even Walmart and Amazon want a stablecoin because it's actually quite profitable to have one. That you are changing the financial system through crypto.
So Bitcoin's not at the top.
Yeah. So if you again model this out and utility, because remember, stablecoins is only a $250 billion market today. So you realize that stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance.
Wow.
So the U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the U.S. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the U.S.
And then therefore, Bitcoin will continue to go up?
Yeah, because Bitcoin secures the entire blockchain.
Tom Lee's thesis on Bitcoin and stablecoins points to a profound restructuring of the global financial system, one where stablecoins are no longer speculative tools but act as practical banking alternatives, and Bitcoin serves as the foundational settlement asset. This emerging digital infrastructure isn't operating in isolation. It's integrating with traditional finance, especially during periods of stress, offering new tools to assess risk and resilience in markets. Lee's research is rooted in real-time data, particularly credit market signals like high-yield spreads, which he argues are more reliable than equity trends or economic forecasts. For instance, during recent market sell-offs, while recession odds were placed above 60% by many economists, high-yield spreads barely widened by 150, 200 basis points, far from the 800 needed to signal deep financial distress. This gap between perception and credit market reality allowed Lee to maintain a constructive outlook, noting that such conditions historically lead to sharp, V-shaped recoveries when there's no actual recession behind the panic. In this context, Bitcoin and stablecoins aren't just growing in market cap, they're being stress-tested and proving useful in real-world financial conditions. Their rising relevance, especially when traditional markets falter, signals that a new kind of financial foundation is forming, one where digital assets, liquidity signals, and credit sensitivity redefine how capital flows and risks are measured in a rapidly evolving global economy.
It's a lot of it is evidence-based because we do a lot of sensitivity analysis to try to understand where we are in markets. So a lot of our statements that we make are high probability statements. But for that to actually happen is luck, in a sense, right? Because something that has an 80% chance of happening doesn't prevent this being one of those 20% days that it doesn't happen. So, right, because let's see if something happens 90% of the time and it's happened a million times, but the next 3 times it doesn't happen. So like those 3 calls fail. Statistically, it's still going to stay at 90% for accumulated history. So like it is always risky to say something has a 90% chance of happening, but that's usually the reasons we make these kind of calls.
And just quickly, at a very high level. So when you're ready to say, okay, the S&P is going to jump and there's like an 80% chance that's going to happen, what signals are you pulling from? Like you said, you're looking at the sensitivities and different evidence.
Yeah. Well, a lot of times Markets make big moves because of surprise. So we have to, like today, we're seeing it today with like Tesla. But the reason there's a surprise is that in a general sense, there's something that, let's say, anchors the valuation of a company. Let's say it's earnings or this S&P. Like, let's say that what anchors it is the Fed's dovish, okay? But then we worry about tariffs and recession. So, like, that's pulling down the market. You can always look for what will counter that argument of recession. And, like, for us this year, it was the high-yield market because high-yield spreads need to widen to like 800. The spread over treasuries has to be 800 basis points. So if the 10-year is at 4%, high yield would need to be at 12% to tell you that a recession is almost guaranteed. But high yield during the tariff turmoil only widened by 150 basis points or so, maybe 200, which is just a growth scare, if even. So the reason we stayed bullish into the April low was because high yield said the chance of recession is probably 10%, whereas the economists were saying it was 60, and we could tell by positioning and what stocks were selling off. Right, the S&P down 25% has priced in like a 60 or 70% chance of a recession. So that's how we can kind of go on and say the market could make a full recovery because high yield is telling us there's not a recession and it's a better economist than economists. So we do have a published history of our research, so our clients can fact check us. But as the market was falling after Tariff Liberation Day, it was falling in a waterfall decline. And so we wrote very early that there have been 12 similar waterfall declines.
What's a waterfall decline?
It's a stock market that falls more than 10% within, I think we did it as a 2-week period. It's really rare to basically like literally cause a plane to drop, 10,000 feet. And almost every waterfall decline is a V-shaped bounce unless there's a recession. So that's why we got so keyed up on this high yield market, because if we fall but we don't have a recession, that just means everyone just panicked. They did a fire-ready aim. And so we argued you would have a V-shaped recovery. And a V-shaped recovery is a symmetric bounce back to the old highs. And, of course, everyone argued against it for logical reasons. They said, tariffs, they're not going to be solved for a year, The Fed's not your friend. The Fed is there's no liquidity coming like in 2020, so you can't have a bounce. There can't be any fiscal stimulus.
2025, no liquidity.
Well, no, in 2020, the Fed did
that's when they said it. Okay.
Fed did a lot of QE.
Right.
And they're like, there's no QE coming. But we said that history says you have a V-shaped bounce, especially if there's no recession.
Okay.
So that's what made this so hard for people to accept, because the Fed was hawkish and we still had a V-shaped bounce. I think that's the real lesson. The Fed liquidity is a myth. You don't need Fed liquidity for stocks to recover. I'd say that's really my takeaway from the bounce. And then for this week, there is an old adage that when it comes to war, you sell the buildup into war, but you buy the invasion. Right?
That's a crazy saying.
Or they say you buy when the guns fire, you know what I mean? But that's true. So we were advising our clients that you sell the buildup, but you buy the invasion. Well, so here it was our calculation, which I think maybe people would agree. The U.S. wouldn't take action if they thought it would daisy chain into a prolonged war, because there's no appetite. And Trump clearly said he doesn't want to pull us into a war. So if they're taking action, they've either signaled ahead to Iran that this is a limited action, or they know that whatever action they're taking is decisive and limited in scope. So that's why I could see why you would buy the invasion, right? And who knows? There's a lot of signs that maybe we did help indicate to Iran it's limited, because, Iran had the trucks and the U.S. was aware of all these trucks moving material, but they didn't stop it. So it was sort of like, look, we don't want to topple the regime necessarily, but we're going to blow this thing up. And I don't know. I'm not a political expert. I'm just saying I can understand why we're rallying today.
Lee's core message is that markets react most sharply not to raw data, but to surprises, moments when reality deviates from the prevailing consensus. That's why understanding market positioning, sentiment, and expectations is just as important as the actual economic figures. He challenges the common belief that a hawkish Federal Reserve automatically blocks market recoveries. Instead, Lee points out that recent rebounds in risk assets amid rising rates and global uncertainties show that Fed liquidity isn't the only force behind equity performance. Investor psychology, historical price trends, and credit risk pricing remain crucial to market dynamics. This integrated approach, combining macroeconomic data, market structure, and behavioral insights, helps explain why stablecoins and Bitcoin are increasingly attracting institutional interest. Stablecoins act like short-duration dollar substitutes, offering easy transferability and attractive yield. Lee highlights that entities like Tether have become some of the most profitable financial players, not through leverage but by performing core banking functions such as holding treasuries and issuing liabilities. Meanwhile, Bitcoin's role is evolving from a speculative asset into a strategic reserve, providing the trustless foundation that stabilizes the growing ecosystem of collateralized digital dollars. This symbiotic relationship is why governments and corporations now treat these technologies as strategic infrastructure rather than fringe experiments, with companies like Amazon and Walmart exploring stablecoin use for cost efficiency and streamlined settlement. For investors, the takeaway is twofold. Traditional macro indicators, especially credit spreads and volatility, still offer reliable signals for market risk, and the parallel financial system built on crypto rails is no longer speculative noise. It's generating real cash flows, managing actual capital, and influencing global dollar demand. As this convergence deepens, capital allocators must integrate both macro and on-chain analytics to stay ahead. The divide between crypto and traditional markets is fading, giving rise to a unified financial landscape where Bitcoin not only coexists with but increasingly supports the evolution of conventional asset. For more Daily Dose Crypto News, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.